Good morning, ladies and gentlemen. Welcome to our webinar today, hosted by STANLIB. My name is Keto Gunene, and I'm the coordinator for today's webinar. Our topic is what's happening in the SA listed property sector, all you need to know, which will be presented by Keillen Ndlovu. I'll introduce him in just a few seconds. But before I start, I just want to do some housekeeping to make sure that everybody who's a first-time user of our webinar facility is on board and understands what's happening. So you're going to be seated for about 40-45 minutes, which Keillen will take you through. What you need to know is, first of all, if you have any questions, there's a questions box on the panel on your right-hand side. You can type in your questions through the section, and then what we'll do is at the end of the webinar, we'll address those questions to Keillen. Secondly, I want to make sure that everybody can hear me clearly. There's a small high five. It looks like a little hand on your panel on the right-hand side. If you can click that hand for me, that will indicate that the sound is good and you can hear me and we can continue. Thank you, Wasim. I see some hands. Thank you, Wiko. Thank you, Tyrone. Thank you, Stefan. Thank you, Sharon. Righto. So all the hands are going up, so I'm glad the sound is good. If it's not loud enough on the panel, on the taskbar at the bottom of your screen, you can just increase the volume and you should be good to go. Okay, just a reminder, questions, we will read the questions, but we'll address it at the end of the webinar. So if you've typed your question and you don't hear an answer immediately, please know we've received it, but we'll address it at the end. Okay, let me tell you a bit about our presenter now, who is Keillen Ndlovu. Keillen has got a BCom Honours, a CAIBSA, a PDP, which is Property Development Program. He's the head of listed property franchise. He's got 14 years of industry experience, 13 years related property experience at STANLIB. So after beginning his property career with Standard Bank Properties in 2004, Keillen transferred to STANLIB in 2005 as a listed property analyst. On successfully assuming increased responsibilities and fund management exposure, he was appointed head of STANLIB's listed property franchise in 2010, after becoming a full-time fund manager in 2008. The listed property team has won numerous awards over the past decade, and under his tenure has expanded its listed property offering from South Africa to developed markets. Keillen has a tangible passion for real estate and listed property, as well as a long-standing love for photography. Keillen is also a keen motorsport enthusiast. So that gives you a little bit background and what you need to know about your presenter today. So that's why we've got him here today to talk to you about the listed property. So I'm going to hand over to him right now, and then at the end, we'll address your questions. Good morning, Keillen. Thank you so much for attending and taking the session for us. Good luck.
Good morning, Ketia. Good morning, everyone. So today we'll talk about the STANLIB Property Income Fund. So our focus is on local property markets. As you know, we also run offshore funds. We'll touch on offshore markets later on, but mostly relating to Eastern Europe. So move on to the first slide. It's not quite a pleasing slide, given that we've seen actually returns of over almost like 20% per year for the last 15 years or so. So listed property has been the best performing asset class, but year to date, what we've seen is the sector fall by about 21%. That's on a total return basis. So it's lagging actually the other asset classes, equities, bonds, and cash. So the reason why the sector has actually lost so much this year is mainly because of three reasons. The major reason is that at the beginning of the year, we saw companies in the what you call the resilient stable of companies. It's four in that space. We've got Green Bay, Nepi, Fortress, and Resilient. They've fallen by about 40% to 60% year to date, and they made up about 40% of the index at the beginning of the year. So now about 27%. We'll touch more on those companies later on. And then the second reason has been actually offshore markets with the rand strengthening at the beginning of the year. So given that offshore exposure is almost about 40% of the sector, we saw companies exposed to offshore markets actually take pain as the rand strengthened. But lately with the rand weakening, we haven't seen that benefit, mainly because of the negative sentiment on the asset class. The third reason will be actually economic growth. We've seen that South African economy has been struggling, and that actually filters through to the property fundamentals. So it's been a challenging year so far. But if you break down the returns, you can see that January and February were the worst months. Then we've seen a recovery or basically flat returns from March all the way to September. So Jan and Feb, it's mainly because of those reasons that I highlighted, where we saw that a massive actually decline in share prices, 10% in January and then 10% in Feb. And there was a nice recovery in April, where the markets went up about 8%. And I find one thing to highlight as well, before I talk about it in detail later on, is that the fund is always fully invested. So keep cash at about 1 to 2%. So when the market falls, let's assuming other funds will hold cash 10, 20%, they'll do better than our fund. But when the market recovers, we saw that in April, because we are fully invested, we saw the fund actually do quite well versus our peers, and also outperforming the benchmark as well. So that's one thing to actually keep note of, that we're always fully invested all the time, and that we've seen most of the volatility in January and February. That's what's led to all the 20% plus decline. So now we talk about the resilience table of companies. This has been actually well documented or well publicized in the media, emails. I've seen WhatsApp messages as well. So the resilient group, just to refresh you, it's 4 companies. We've got NEPI, there's Green Bay, we've got Fortress, and then Resilient, which is the parent company. So the couple of concerns that have been raised by various market players, including some hedge funds, you've seen some reports circulating. So the first one has been to do with the Siyaka Trust, that's their BE Trust, where the group had made actually good margins out of that, probably lending at a higher rate to the trust and then paying that out to investors as distributions. And it happens generally in the sector, but I guess the quantum here was quite bigger compared to other companies. And so they've actually eliminated that. That's why their returns have been revised downwards. And the second point has been cross holdings. That stable, they all actually held, not all of them, actually Resilient held Fortress, Fortress held Resilient, and they all hold Green Bay and NEPI as well. So that's why they call it cross holdings. So Resilient has eliminated the cross holding structure with Fortress, and then Fortress still holds Resilient, so there's no cross holding. So that's been actually resolved. And then there were concerns around the cash flow hold, that there's no cash to pay out distributions. So property companies operate differently. What you find is, well, they all issue like scrip dividends, where actually instead of them paying out distributions, investors will opt for actually the shares in the companies, and they will actually paid out maybe using debt. But if you reconcile that, you find that there is no cash flow hold. So we're not concerned about that. And the other concern has been inflated property values, that the assets are actually expensive. So what they've done, they changed the property values. They've moved to JLL, which is a global company. They started the whole process from scratch. And when they've done that, we saw the property values actually go up by about almost 4%. So that takes away that concern that has been raised by some of the market players. So the last one, which is a manipulation of share price and called other issues, no one can actually really give an answer to this. We're waiting for the outcome from the FSCA, or the former FSB. So that report is still outstanding. They're busy doing their work, and we believe it probably might take several months. Resilient actually did an independent report or review to raise all these concerns that come up. That's what we call the FACI report. And the market, or some of the market players, believe it wasn't independent enough. And so you see now there's actually engagement with shareholders. There's about 10 shareholders who've signed a letter to try to accelerate this investigation process. And we are busy engaging with various boards from NEPI to Green Bay, Resilient, and Fortress over the next couple of weeks. So this actually may take some time, but there's a lot that's happening in the market to address these concerns that have created a volatility in the market. But on the other side as well, so we talked about the negative, that's the Resilient stable has caused all the concerns. If you look at the underlying property performance of most of the companies that reported in August and September, and most of them with retail portfolios, you can see the numbers actually looking very good. From Hyprop with about 4% like-for-like net operating income growth, and then EPP, that's a company in Poland, and those returns are in euros, very solid. and NEPI Castle based in Eastern Europe as well, with Romanian assets about 4%. And Growthpoint being the largest listed local property company, 4% growth. On the left-hand side, that's Fairvest. That's one of our favorite companies in the portfolio. It's a small company. They've got assets in the townships, so non-metropolitan areas, or rural retail, and that does actually very well. And they've been achieving solid, strong numbers of almost 12% like-for-like growth. So there is actually positive news in the sector, despite all the volatility we have seen. Then we talk about the fund, the STANLIB Property Income Fund. So this fund is about 10 billion rand in size. It's the largest fund in the listed property space, and it's got one of the longest track records. It was launched in 2002, and I've been with this fund from 2004. So the returns, as I mentioned earlier on, have been amazing. If you look at since inception, almost 20% returns. That's your annualized returns, 20% per year. And then over 10 years, about 14%. 5 years come down about 10. So the key focus is what's led to the dilution over 3 years. The returns are flat over 3 years at about minus 0.3. It's mainly because of year-to-date returns, where we are down 22%, and the benchmark about 20%. So this we underperformed year-to-date, but what we've seen from March all the way to August, we're moving in the right direction. The fund has been actually outperforming the benchmark by at least 1%. Even look at latest numbers, we check them now and again, September, still looking good actually for the fund. So returns down 22% year to date, and we believe actually this actually reached the bottom in terms of the market, despite actually weaker fundamentals going forward. We'll touch on the fundamentals in the next couple of slides. So what does the fund hold? What are our biggest overweight positions and underweight positions? So that's all relative to the benchmark, which is the SA listed property index. So these numbers are up to end of August. There's been a few changes since then, but our biggest underweight at this stage is Redefine. You can see just over about 6% underweight position versus benchmark, and then Growthpoint over 5%. So Redefine and Growthpoint, they are some of the biggest companies in South Africa, but we're not excited. Their returns are anywhere between 4.5% to 5.5%, so slightly in line with market average, if not lower. With Redefine, our concern is that there's a portion of almost 10%, which is non-sustainable income, what we call non-recurring income. So the quality of earnings not as good. Growthpoint, you may have read, maybe if you get time, just check MoneyWeb. They talked about Growthpoint's quality of earnings today. The article a bit negative, I'll probably say, but they do have an element as well of a non-recurring income in their portfolios. Their growth is 4.5%. And then Attack, which is one of favorites for most of the retail investors. I guess going back to when it was unlisted, we don't hold any Attack in the portfolio because of valuations. It's trading at under 6% yield, and the sector is over 9%. So from a yield perspective, not that attractive. Their biggest asset is Mall of Africa. So I'll move on to the left-hand side, which is our overweight positions. Resilient at about 2% overweight, NEPI Castle 2%, and then Storage, it's about almost 2% as well. So Resilient, we had an underweight position over the last year or two, and then we closed that underweight, and then we actually came up with an overweight position, and now actually trimming that, given actually the recent good performance we've seen in August, all up to early September. And the NEPI Castle as well, the currency helping the stock, as well as good results. So this counters the top two post end of August. They're down to about 1% overweight position, and Storage is actually our biggest overweight position now in the portfolios. Why do you like Storage? Is that they're in a different market. You may have seen as you drive around, they've got these self-storage buildings with red colors. They've got distribution growth outlook of about 8 to 10%, and they're trading at a yield of about 8%. So they're in a niche market, probably less competitive, and they're buying out other smaller players. And then Investec Australia, that's in Australia. Australia is a solid country, continues to do well, and we like that company. It's well managed and continues to deliver. And if you break down the sector, the local property market, the retail sector is the biggest sector in our portfolios or in the benchmark at about 53%. And then office market 24%, industrial 15%, In the other section, you've got storage, as I mentioned, and there is also residential property. And then some small buildings like hospitals as well. But it's a sector that's still fairly small and that will take time to grow. So the key focus here will be the retail sector and the office sector. So talking about the office sector, you've seen as you drive around Joburg, Pretoria, Cape Town, everywhere, there's lots of to-let signs. And actually, almost every building now where you go is all these signs. And in Rosebank, where we are now, just across the road in Jan Smuts, Redefine's got this building where they offer you up to 50% rent-free for 2 years. And then in the CBD on the right-hand side, you can get up to 12 months rent-free. So it's quite a competitive market because we've seen actually vacancies. Official numbers say office market is about 11% vacant, but doing our work, we believe those vacancies actually much higher. And what we've seen is that rental growth has been negative. Numbers come out of the listed property market, it's anywhere between 2.5% to about 10% down in terms of rents as leases expire. And we believe actually this over the next 2 to 3 years, this market is likely going to see most of the challenge compared to maybe the industrial market. And these are all buildings, what you call B grade buildings, C grade buildings. They're challenged to let. So not only the B and C grade buildings, if we look at even new offices as well, these are amazing buildings. Actually, we took all these pictures. Actually, in fact, all the pictures you see in the presentation is just us driving around, looking at what's happening, checking up the trends as well. So we like to be on the ground to understand what's going on and to be ahead of the market as well. And in some instances, we'll actually call those numbers that you see on those billboards just to get a sense of what's happening in the market, how desperate probably the brokers are, and then it helps to actually focus the companies better. So these shiny buildings that we see here, they've got at least 30, 40, if not 50% vacancies. So you've got challenges with the old buildings, and then the new buildings as well, they're looking for tenants. They're going to actually be competing with the older buildings and maybe reduce the rents. And if you've got a choice, you probably go to a brand new building as opposed to a new one. And this will probably take time to let. And the one on the left-hand side is actually a former village walk. Some space was meant for momentum in moving from Centurion to Sandton. Here they're not moving there, and that's created actually a huge vacancy. And we expect this market to continue to be competitive and rents to fall. In the industrial sector is probably the most probably defensive sector. Vacancies are about 3.3%. As I mentioned, the office market is 11% vacant. Industrial market continues to do well, but we're seeing a shift as well where tenants are moving from older industrial buildings to new industrial buildings. So there's no actually new demand. It's just basically movements from older buildings. And we expect actual vacancies to increase over time in the industrial space as tenants vacate older buildings. And some of the pictures you see here in Durban, we like Durban as an industrial market because it's close to the port. That actually makes it actually much more competitive. And I guess it's difficult to get a good land there as well, given that Durban is actually not flat, it's hilly. We've got 333,000 square meters on the left-hand side being done by Fortress Income Fund. And then in Cornubia as well, in Durban North, they've got huge developments coming up as well. But again, as well, same story, getting actually existing tenants from older buildings. So move on to the retail sector. So the retail sector has actually done fairly well in the listed property market because the listed property market generally holds better quality assets compared to like average assets we see as we drive around, we do our shopping. On the left-hand side, the strongest segment is actually in Eastern Europe. We've got Mass, Napier Rock Castle. These malls are doing anywhere between 7 to 8, if not 9% sales growth or trading density growth year on year. Whereas in South Africa, on the right-hand side, Growth Point, which is the biggest local company, 1% sales growth. And then Emira, Investec. On the right-hand side is all the South African-focused companies. And in the middle section, Resilient, Fortress, Rebosis. They're more in the non-metropolitan areas, more in the township areas or rural areas. And these malls have continued to be more defensive compared to the much bigger ones in the CBDs or in the major cities. EPP, you may see there, they've got flat sales growth. That's in Poland. What happened in Poland, the government has actually changed their laws. They're saying there's no trading on Sundays. So most people trade or go to shopping centers on Saturday and Sunday. So if you close malls on Sunday, it does affect the sales. But what we've done, we've stripped out Sunday to get a sense of how strong these portfolios are doing. They're anywhere between 8 to 12% sales growth year on year if you strip out the impact of Sunday trading or negative number coming from Sunday. And if you look at Joburg on the right-hand side, that's Fourways Mall. This mall is doing a huge extension of 100,000 square meters. Just give you a perspective, 100,000 square meters, it's bigger than Clearwater Mall, for example, just the extension alone. Fourways Mall is currently about 75,000 square meters. So when it's complete, they're going to do it in 2 phases. First phase next month, and then the following phase about March, April, to almost 75,000 square meters. It becomes as big as Mandlin Shopping Center. On the left-hand side, you've got Cornubia Mall in Durban. It's quite an interesting one as well. If you look at Durban, you've got Gateway, not just across the highway, then you've got a new mall that's come up as well. So what's this done is created so much competition for shopping centers. And you've seen actually, we measure foot count per square meter. So foot counts per square meters in the malls is actually down 6%. So 6% because of its challenging economic environment, as well as actually shoppers having more choice to decide where to go to. If you're in Durban North, you've got Cornubia, you can go to Gateway, and even Ballet as well. Ballet's got actually a new mall that's actually opened. So sales growth on average in the sector actually flat, whereas the listed companies, because they've got better quality assets, they're achieving anywhere between 2 to as much as 4 or 5%. So our biggest concern is actually the new supply coming up in a weak economic environment, as well as actually store closures. Last year, we experienced a lot of stores closing down. Stellarford was the biggest one, and also the international retailers from 9 West to Mango all closing shop. And where do they close shop? In the bigger shopping centers compared to the smaller ones. In the metropolitan areas as compared to the township or the rural areas. That's why the bigger malls have actually felt the pain of these store closures. And then now we have Edcon, or Edgars mainly, and they occupy about roughly about 1.5 million square meters of space. And what we've been picking up is that they're looking to close up to 1/3 of their shopping center. That means 500,000 square meters. And if things don't go well, they could even close up to half of their centers over the next couple of years. And Edcon is a big tenant, almost 7% of total retail space in South Africa, and about 10% of space in the major malls across the country. So that's our biggest concern right now, the trading of Edcon, and how long actually they will continue to survive in the current form. So they are closing down stores, and we've seen actually most of the malls see some of the closures. And how big is Edcon in our portfolios? Edcon is about 2% of the listed property space. If you add everything, add offices, industrial, and offshore exposure. So it's not as big as it was before, but the challenge is that it's big in the retail space, and there's also ripple effects to other retailers, industrial market, logistics as well, and they employ a lot of people, as well as the fact that some of the leases signed in the malls, they are signed on condition that you've got an Edcon in the mall. So if Edcon closes down, that actually creates concerns for other tenants or even bargaining power. So Edcon is looking at a number of ways to actually increase their profits or trading. So they're going to reduce space or close down some stores completely, or reduce the size of the stores in some of the malls, as well as actually negotiate rental reductions on existing leases. As far as we know, they haven't actually reduced rents on existing leases, but they are closing stores and reducing the size of the stores. So we continue to do lots of work on Edcon. So yes, there are actually retailers closing down, but also have actually new ones coming up. We've got Leroy Merlin coming up. We've got Decathlon as well expanding, and then we've had some Turkish retail as well looking to come to South Africa. That's LC Waikiki, but it's not probably big enough as well to support some of these store closures if you've got a weaker mall. So we continue to actually keep abreast of the trends in the retail space. Then now move on to offshore markets. As I highlighted earlier on, I said about 60% South Africa, 40% offshore. So the exact number is 62% exposure to South Africa, and then 38% offshore. So what this simply says is that from the distributions actually paid out to clients or investors, is that 40% comes from outside South Africa. And out of that 40%, almost half of it comes from Eastern Europe. Eastern Europe is becoming big in the local property market. And then the balance comes from mainly Australia, we've got UK, and a bit of Germany as well. So what we're going to do today, we'll focus more on Eastern Europe, get a sense of actually what's going on in those markets. And our model, as I mentioned earlier on, we drive around in South Africa, get a sense of what's going on in these markets. We do the same actually in the offshore markets. So I've been to all the Eastern European countries, or all the markets where we do have offshore exposure, and seen at least 90% of the assets we're invested in. So Eastern Europe has been very actually topical, interesting, and South Africans continue to dominate that market. So look at the slide, which shows actually flows of money going into Eastern Europe property markets. In 2016, 79% of actually deals done were done by South Africans. So that means South Africans, almost 80% share of deals or flows going into Eastern Europe. And then last year was 61%. So still a very big number. If you look at where we are, our size as an economy, competing with maybe you've got Germany, you've got UK, there's US as well. But it's a market that we've been actually liking for quite some time, and this market has delivered. It does come with risks, I guess. You're moving into a market that you're not familiar with. But what you're seeing is that these companies partner with locals. And then why actually South Africa, not Germany, not France? You find that's more of a risk-return perspective, where if you look at Germans and French, they see these markets as riskier. They'd rather be in their own markets that they probably understand, and they've been banned before, actually, before this subprime crisis. Whereas for us, we see actually opportunities and first mover advantages in these markets. As I mentioned, we travel. We like to see what's going on, look at the quality of the assets, look at how busy they are as well, and just get comfort around the tenants, the trading. We've been to Bulgaria, talking about South African dominance. If you go to Sofia in Bulgaria, the top 3 malls are owned by South African companies. That's Paradise Center at the center there. That's one of the best shopping centers in Bulgaria, if not the best actually. And we just don't hear from the listed property companies. As we travel, you'd go out in the evenings, you meet with the locals, get a sense of what they like, what's their best center, and they love the center. And going through it, visiting it, a good quality, well-built, and amazing tenants. On the left-hand side, you've got the mall, which is owned by Hyprop. So all these retailers you see there, from Mango, you've got LCY, KK as well, Tommy Hilfiger, they're all international tenants expanding into these markets. And then we've got Sedica as well, owned by Napier Castle, and also does well. So they've got the top 2 malls in that space. Then move on to Romania. These malls are amazing, and looking at these images, they're just world-class, good designs, well-built. That's where actually most of this money has been going to building actually all these assets from scratch, basically. Like Mega Mall is probably 100% funded by South African money. City Mall, in City Park Mall in Constanta in Romania, the extension as well. When these companies do all these book builds, that's where this money is actually going to. And then Promenade was an existing asset bought by Napier Castle. And around these nodes, as we travel, you can see there's some vacant land. So around Promenade, there's going to be a huge office block coming up there, and that will help to drive actually the trading in these malls. So we like to invest in the big dominant malls that trade well, achieving 7 to 8% sales growth. Then move on to even other markets as well. As I mentioned, Central and Eastern Europe, we almost in all the markets. We don't have Russian exposure because people ask about Russia, and no one's going to Russia or Ukraine. It's Croatia, it's Hungary, Poland, and these are great assets, as you can see here from these pictures, from Arena Center to Arena Plaza to Serenada Mall as well. Well built, and the quality is better than any mall that you find in South Africa. And then Eastern Europe. Why Eastern Europe? So we like to look at not just the malls, not how good they are, not how busy they are. We'll look at the economy in general. On average, we're expecting a real GDP growth to about 3% to 4% over the next couple of years. So on this slide, the dark line, the first one, just shows the 2017 GDP growth. And the next bars, they show the actually focus up to 2022. So Romania last year grew by about almost 7%. That's amazing growth. And look at South Africa for the next year, 2 years, unlikely to achieve growth. Probably 1% would be a good number. 2% is a bit of a stretch to get to those numbers. And we're seeing our numbers being revised downwards, whereas Eastern Europe is growing at 3 to 4 times the rate than South Africa. That's from an economic growth perspective. And also look at unemployment. So unemployment across all major markets is seeing that number coming down, whereas locally we've been stuck at 25-30%, that number not coming down at all. But these markets on average 5% or so unemployment to 6% and coming down, driven by GDP growth. So unemployment comes down, that means people do more shopping, they buy more apartments, they help to drive these markets. So what are the risks with Eastern Europe? I guess probably one would be currency. Each of these markets, they've got their own currency. Yes, pegged to the euro, as well as actually political risk as well. But political risk is everywhere now, whether it's the US or UK, Turkey, almost all markets. But what we like to look at is the number of retail available space. So they still have actually low retail space per capita, and these economies are growing and well-educated populations. And for example, in Poland, Germans are actually outsourcing most of that, even the police as well. They run out of the police force and they have to recruit in Poland. It just shows you how strong and well-educated these markets are. Then move on to the valuations. This is quite a busy slide. It's probably the busiest slide in the presentation. This just basically highlights that once we've traveled, we've seen the properties, we've met with management, we've gone to conferences, we talk to other analysts, sell-side analysts as well, and then we integrate all this, come up with our own focus and numbers to get to the valuations. So the vertical axis basically shows the dividend growth or distribution growth over the next 3 years, so an average over the next 3 years, and then the horizontal axis, that's the dividend yield. So the SA listed property sector is trading at a 1-year forward yield of 9.1%. So that's fairly in line with the bond market, and we haven't seen this in a long time where property trades in line with bond yields. It normally trades at yields of 100 basis points, 150 basis points below the 10-year bond yield. Why is that? It's because we've got distribution growth. So now the distribution growth has come down. It's not 10-15% like we've seen over the last couple of years. So that's one thing to be aware of, that given slowing economy, our distribution growth is slowing too. Still positive. We're focusing about 5 to 6% distribution growth. Fairly conservative. Some numbers I'm seeing in the market, some players looking at 6 to 7, but we're at 5 to 6% distribution growth. So above inflation of 4.5%, 5%, mainly driven by offshore markets. So out of that 5 to 6% distribution growth, offshore markets, we're looking at about 8 to 10%, if not higher, and in euros or hard currency. Whereas local markets, we are looking at, so local markets about 3 to 4% distribution growth. So that's lower and that's below inflation and that's below long-term average. And we believe these are reasonable numbers given where the economy is, given the oversupply in retail, oversupply in offices, and vacancies that could pick up as well in the industrial market. Some companies are going to achieve negative distribution growth. So you're going to see lots of surprises, negative surprises will coming through. And then we continue to assess the quality of earnings. We'd like to be in the strong, sustainable income growth as opposed to one-offs, and we continue to watch for that. So from a yield perspective, the sector is looking reasonable, and then the growth is fairly positive at 5 to 6%. So it's not going to be the same as the last 10 years or 15 years, and therefore don't expect 20% annualized distribution growth going forward. So from the current levels with the yield of about 9%, growth of 5, on our base case scenario, we're looking at probably 12 to 14% total returns, income plus capital over the next year. From a valuation perspective, not just the yield perspective, we look at NAV as well. So NAV is going to be crucial as well going forward, more so when actually the earnings slow down. So our market has been probably more reliant on distribution growth at the expense of NAV. Now we're seeing a change as well, a shift that people want to know what is the net asset value of these companies. And the sector is trading fairly in line with NAV at about 0.98 or maybe 0.02% discount to NAV. Whereas the long-term average, the sector is traded at 18% premium to NAV. So basically what they say is that the sector is trading at a level in line with the physical assets or the underlying assets, whereas previously it was trading at 18% above the valuation of physical assets. So we believe that the sector should trade at a premium, maybe not 18%, maybe 10% premium, given that if you're listed, you've got so many advantages. You've got liquidity, you've got diversification, diverse management, different sectors as well, ability to switch amongst our various sectors. So the sector over time should probably get back to a slight premium to NAV. From a total return perspective over time, so always like to point out that property is more about income as opposed to capital returns. So income return over since 2005 has been almost at 300%, and then capital return are just over 100%, with 400% total returns over that time. So we'd like to look at longer term numbers that the compound effect of reinvesting that income creates actually amazing total return over time. Whereas investors tend to focus more on capital returns, our models focus more on income return, because income return drives capital returns over time. And what we've seen with our fund as well, we've done some work in-house. Our fund, compared to probably similar funds with probably similar track record, it's achieved the highest income return compared to any other fund. That's what our main focus is. Our primary focus is income and then capital growth over time. So to conclude on the upside and downside for the sector, what's the upside? If it's better than expected economic growth, we're waiting for that, and the market has been waiting for Ramaphosa to come through. It hasn't really come through, and if it comes through, then it'll be positive for the market. And then if the rand weakens against the euro, given that we've got huge exposure to the eurozone, mainly in Eastern Europe with euro-denominated leases, that actually helps the earnings. And then we do have corporate action. Valuation divergence, as we've seen with the yields in the sector, the huge divergence that actually creates opportunities for companies to take each other out. And the resilience table is very key for the sector. So almost a third of the sector, if there's a positive outcome from the investigation or from the interaction with the various boards, with the 10 companies that signed the letter, that could be positive for the sector. Rate cuts, probably unlikely at this stage. But if they do come through, they do help in terms of spending. On the downside is bond yields. If bond yields continue to go up, it's negative for the sector. Emerging market sentiment, negative sentiment, they're not good for South Africa as well. And our biggest concern as well is tenant consolidation. We've seen most of that happening, be it Sasol, Discovery, all consolidating into one big building and vacating smaller buildings that are spread across most of these cities. And as well as not just consolidation, with what we call densification, where actually the size of space actually becomes smaller, like per head, square meters per head, whereas long back used to work in big offices, dominant offices as well, and big corner offices. That's not actually happening going forward, as well as ability for people to work from home and hot desking, which requires less space for corporates. And then investor hesitation to the sector. We've seen actually negative headlines on the sector over the last couple of months, even today as well. That doesn't actually help. So lots of investor education is required to help investors understand how the sector works. And probably one of my biggest concerns at this stage is Edcon. Edcon is crucial in the retail space, and they need to have a good Christmas to survive. If Christmas is not good, there's actually a risk of Edcon failing. So that's the property story. We've covered basically the local markets, offshore markets, and I'll hand over to Katie for questions.
Wow, thank you so much, Keillen. That was very good. I feel like I've got insider trading info from that presentation. I know things I shouldn't know. So let's see. There's some questions from the field. The first one, things you were discussing in your first few slides. Please discuss the high and low road scenarios for Resilient, Napier Castle, and Fortress, A's and B's.
Yes. So what we've seen, we've probably seen most of the negative news, I would say, because these companies are trading at discounts to NAV, and they're now trading at high yields compared to the sector. So probably from the negative side, we've seen most of that. And where's the upside, or what could be the next stage? It's a positive outcome from investigations, but that may take time. And then probably an extreme kind of scenario is them actually being even some consolidation within that stable, some changes, whether it's management or the teams, as we've heard people actually talk about that they've got great assets and some of the best retail assets in South Africa, and we believe they are actually solid in terms of that. So there are opportunities from that perspective.
Okay. There's another question here. Are there enough consumers with sufficient disposable income to support all our malls?
Yeah, that's our biggest headache in terms of the size and number of malls. And we believe that, so we've seen that the biggest shopping centers now have got the biggest vacancies of about 6%. That highlights that we're actually in an oversupply territory.
Okay. And then where is SA in terms of online shopping trends?
So online shopping numbers are anywhere probably between 1.5% to 2%. So the last time we saw it like 1.1%, but that sector is growing at about 10 to 20% per year, so around about 1.5%. So it's still low compared to the UK or US, which are about 12 to 16%.
Okay. And then there's another one here. This one's asking, is there a correlation between SA GDP growth and office rental growth?
Yes, a very strong correlation in that market.
Okay. And then what's your view on residential property?
We always get this question on residential property. So there's two sides of the residential market. We look at, from a listed perspective, we focus on the rental side of it. So it's been a challenging sector right now. You're seeing actually most landlords offering not to take any deposits because the market is challenging, and vacancies have actually picked up from that market given the challenging economy. So we're cautious on residential. Used to be a strong market. The demand is there, but yeah, people don't have to spend. All
right. Here's a question here from Lynette. Can you clarify what investors are looking for when the increase in this growth is based on additional income generated from international property investment companies?
So I guess it's all to do with diversification. As I highlighted that 40% is offshore now. So if we didn't have offshore exposure, our sector was going to be growing, let's say our focus would have been 3% distribution growth. Okay. But with offshore exposure, we're looking at about 5 to 6% distribution growth. Okay. And you're moving into markets that have less retail, more opportunities as well as now it's moving into the office market that's actually coming through. So it's more to do with diversification in a working environment.
All right. And then we've got Clifford Smith who's asking, how is Liberty 2 Degrees performing?
So Liberty 2 Degrees has gone through some changes. When they listed, they had an external manco and there was a put a structure. So they've eliminated the external manco and they put option. So which aligns Liberty 2 Degrees to the rest of the sector. Okay. And they've got great assets, Sandton City, Eastgate. So from these levels, I think we've seen most of the pain actually coming through from Liberty 2 Degrees. Okay.
All right. Hope that answers you, Clifford. There's another interesting one here from Casperus. He's asking, in a global interest rate cycle with property supply rising and disposable incomes under pressure, is there still any logic for investing in RSA property?
Yes. So we like to look longer term as well. So yes, the market is weak, but what we believe is that property is actually more defensive than other companies or equities. Okay. I'll give you one example. Let's say you invest in a retail company, let's say Edcon, for example, if it was listed. If the sales are down, as an equity investor, you feel the pain immediately. But for property landlords, they still have to honor the leases, whether it's 5-10-year lease, still escalates at inflation 6, 7, 8%. Okay. So property tends to feel the pain last compared to the equities.
Okay. All right, we've got another one, Liam Graham, who asks, we have yet to see any major consolidation in the local market among list property companies. What do you think the catalyst for any deals will be? Surely the current discounts to NAV must be enticing.
Yes, but the challenge is that the market has been volatile. So shares can move up 2, 3, 5% within a day. Okay. So it's been very difficult to price actually these assets. as well as the fact that the sector hasn't seen any good flows year to date, and most investors probably struggling with that. So it's a flow perspective, as well as actually market volatility making it difficult to price these assets. But we believe over the next quarter or so, we're likely to see actually some consolidation starting to happen.
Okay, seem to have one more question here from Simbarashi. They ask your views on growth points, internalization strategy.
Probably supposed to be internationalization strategy.
Yes, that one.
So growth point, give them credit. They were the first movers in Australia, probably on a big scale, when they created Growth Point Australia. They're always a cautious company. They take time to do deals, and when they're comfortable, they go into those markets. So now they've moved into Romania and Poland, and their focus is more on the office sector as opposed to the retail sector like other players. So they're actually moving to different markets in a cautious way.
Okay. There's another interesting one from Ari. He says, hi, Kay. When we talk to clients, we say the economy is weak. How do we explain to clients where all this money is coming from to build these new buildings?
That's a good point. Yeah. So you blame it on a couple of entities from the councils where there is on the land to make it available, to the banks that provide the funding to be in business, as well as developers as well. Developers have to build something to keep going. And what you're finding is, as well as tenants as well. So like office market, for example, there's big corporate consolidation. They want to move into better buildings, green buildings, well-located buildings. And the car train as well has changed actually the dynamics. Everyone wants to be around Rosebank, around Sandton, Centurion as well. So it's that element. And if you look at buildings, over 10, 15-year cycle, we have to move to new buildings and new designs as well. So there's that element that always comes through in the property market.
Okay, that is interesting. Keillen, I think that is all the questions that have come through so far. This has been very interesting for me, and I'm sure for everybody listening. Any closing words, anything you want to re-emphasize before we say goodbye?
Yeah, I guess probably I'd like to reiterate the point that let's focus on income. Yes, capital has fallen. We're feeling the pain. I'm also feeling it. I'm heavily invested in these funds. But what I do focus on in the long term is actually income growth and the ability to reinvest this income at this share price at about 20% or so lower. And we focus on income, as I highlighted earlier on. That's our primary focus. And then our quality. So income driven by quality assets, defensive assets, sustainable growth over time. And then we have an active, actually understanding of the assets as well. Probably always on the ground, keep up with the trends. So like tomorrow I'm going to Namibia to look at some of the assets we're invested in. And then next week we're going to the US and Germany as well, just to keep abreast of all the trends that's going on. When we come back to the markets, to our desk, we do actually stock selection and take a long-term view. That's our fund is known for. It's not a trading fund. It takes long-term views.
Okay. Before I say goodbye, we've got two lucky people who have just slipped in. First of all is a compliment from Mark Deploy. He says, thank you. This was great. Good content, and the web makes it very efficient too. Thank you, Marky. And then Clifford slipped in one more question. He says, how long do you allow clients to hang on to listed properties?
So it comes back to on their risk profile and what's their objective as well. So we believe that there's always a place for listed property. So from an income perspective, you can choose have maybe a bond fund or be in money market. So the difference between property and bonds is that your income grows, whereas in the bonds it's like just flat. If there's rate cuts, your income comes down. So the income element is the major driver for listed properties. So when you talk to your clients, just show them actually where the income is growing. And if you've got an apartment, you don't read the Saturday Star every or Sunday Times now to check what's the capital value of your assets. As long as you're collecting the rent every month, that's what property is all about. And then over time, if you're able to collect your rent, your capital growth will go up over time.
Okay. Thank you so much, Keillen. Very interesting. I hope everybody took something from this. Very good comments coming through. So we'll see you on the next STANLIB webinar if there's one. Thank you very much. Everybody have a good day. If you have any questions, there will be an email that comes out on a thank you note. You can send your questions there. This webinar has also been recorded. Once it is ready and converted, it will be posted on our YouTube channel, the Standard Bank YouTube channel, which will be on the thank you note, as well as the STANLIB platform soon as well. Thank you very much, ladies and gentlemen. Have a good afternoon.